So, financial models are super important to business owners and business leaders in general. They help individuals and corporations determine whether their business is profitable, and if not, where they can make changes to improve. So, I previously created this very basic financial model to illustrate this tool. So, in this first top section, you have the years 2018 through 2020. And these are all our assumptions up here above the gray line. And now these are all in blue because these are our inputs. It's what we input into the Excel, and we can change these at any time. And we can see how they affect what's in the black, how they affect our net revenue, our cost of goods sold. What if we change the costs? How would that affect everything? So you label in blue just so when the models become more complex, it's a little easier to differentiate what's an assumption and what's not. So say we had a company that was selling baseball gloves. And say our first year we sold 100 gloves. And the second year we sold 180 gloves, and the third year 350. Now say our price that year, for all years, we kept constant at $250, which is a reasonable price for a baseball glove. So then we go down here to our cost of goods sold. This is how much it costs to make the glove. So to make one glove, it costs $150, and that wouldn't change as long as we're using the same type of leather, etc. Now down here are the operating expenses, like labor and marketing costs. So say our first year we were small, maybe we only spent $10,000 in labor. And then as we're growing, we're spending more money. By 2020, we're spending $20,000 on labor. And same thing with marketing. Say we didn't do a good job in marketing, didn't do a lot our first year, and maybe we only spent $5,000 marketing. But by 2020, maybe we upped it by up to $7,000. Now down here is our tax. Say we were taxed for maybe our leather, maybe we're importing it. Say there was a 40% tax on our income that we had to pay. So these are all the assumptions. None of these are definitive. They can be changed at any time to see how it'll affect the profit of the company. So down here, below the gray line, is the income statement. Everything that's calculated from the assumptions. So the net revenue is basically the units times the price, giving you $25,000 for that first year, $45,000 for the second year, and $87,500 for the third year. Now down here, the cost of goods sold is basically our units times how much it costs to make each one. So you do 100 times 150, giving you $15,000 the first year, $27,000 the second year, and $52,500 the third year. Now our gross profit would be our net revenue minus the cost of goods sold, giving you our first year $10,000, our second year $18,000, and our third year $35,000. Now to calculate the gross profit percentage in this next line, you basically take the gross profit and divide it by the net revenue. So $10,000 divided by $25,000 would give you 0.4, 40%. And it stayed constant throughout all 3 years. We're about 40% gross profit. Now down here in our operating expenses, we basically just calculated the total. So we added labor and marketing, and that totaled out to $15,000 the first year, $21,000 the second year, and $27,000 the third year. Now down here, the operating income would basically be our gross profit from above, $10,000 for that first year, minus the total cost of operating. So our total operating expenses. So you get $10,000 minus $15,000. Obviously that's negative. So our first year we didn't make any money. Second year, same thing. We didn't make any money. We were in negative $3,000. But our third year, we took the gross profit of $35,000 and subtracted $27,000, our total operating expense that year, and we came out with an operating income of $8,000. Now the operating margin percent is basically your operating income divided by the net revenue, which would give you the operating margin percentage. Now tax that year, we'd go back to up here. Remember we had a 40% tax on our income. So our first 2 years, that didn't apply since we obviously didn't make any money, but our third year, you basically take your operating income, multiply it by the tax, 40%, and you'd be paying $3,200 off your operating income. So then your net income that last year, 2020, would be $4,800. Obviously, the first 2 years we didn't make any money, which isn't very good, but you can see the third year we grew more and made some money. Now it's a financial model because you can go back and change things. Say, hey, what if we cut our cost of goods sold by $30, and instead of 150 we sell it for 120? How would that affect everything? You can see down here, it should load, okay. You can see our net income changed way differently. We paid more in tax that year. Our operating income was way more, and you can see how you can alter things. Say, hey, what if we sold 400 that year? How would that affect everything? Oh, our net revenue goes up to $100,000. Our cost of goods sold, $48,000. And you can see the power of financial modeling and how it's so important for businesses to use to see whether or not they're being profitable, and if not, how can they improve? What can they do better? Can they change the cost of something? Can they spend more on marketing? And it's very important and vital to businesses if they want to succeed. So thank you very much for your time, and I hope you enjoyed the video.